At a certain age, you have to start taking money out of certain retirement accounts. This is known as a required minimum distribution, and we get a lot of questions about required minimum distribution, so I thought I would take the time and explain what your required minimum distribution is, how to calculate it, and the potential tax liability it can create for you. I'm Spencer Ford, CEO and Wealth Advisor with Conservative Financial Solutions, as well as a certified financial planner professional. Let's get into today's video. So it used to be age 70 and a half, then it increased to age 72 and increased again to age 73 with more increases expected in the future. But for now, age 73 is when you have to start taking from your pre-tax retirement accounts so taxes can be collected on those withdrawals. Your pre-tax retirement accounts include things like your traditional 401k, 403b, a thrift savings plan, or IRA. When you put money into those accounts, you made a deal with the IRS. The deal you made was you weren't going to pay tax on the money going in, you were going to wait and pay tax when you took the money out. And why would you do that? Well, the reason is it used to be conventional wisdom or taught, or you believed that you should wait to pay the tax because you'll be in a lower tax bracket when you retire. And more on that later, but essentially, that deferred tax liability has grown and grown along with your account for decades probably, and at your required minimum distribution age, the IRS says you don't get to defer those taxes any longer. You have to start taking out a minimum amount so those taxes can be collected. But how much do you have to take out? Well, that depends. It depends on how much is in the account and your age. So to calculate your required minimum distribution, you have to take the value of your account on December 31st of the previous year and then divide it by a factor based on your age at the end of the current year. Here's the table. So let's say you wanted to figure out your required minimum distribution on your traditional IRA for 2024. You would first need to find your December 31st value of the previous year, which would be 2023. So you just look at your December 31st statement for 2023. Let's assume that value was $1 million. Now, you need to know your age at the end of the current year. So in this case, 2024. Let's assume you would be age 75. We go to the chart and we find your age, we find your factor, it's 24.6. So you take $1 million and divide it by 24.6 and you have your required minimum distribution or RMD amount of $40,650.41. That's just your required minimum distribution for your traditional IRA. If you have other pre-tax accounts, you'll need to figure out what your required minimum distribution is for those accounts as well, and you want to make sure you account for everything because there is a 25% penalty for any portion that isn't satisfied. Here's an extra tip. If you have 3 separate pre-tax accounts, you can satisfy your total required minimum distribution for all 3 accounts from just one account. You just have to make sure that the total amount is correct. So for example, if you had 3 accounts and they each had $100,000 in it, your required minimum distribution off of each one would be $4,065 using our same factor that we had above. You can take all $12,195 from one account and that satisfies your required minimum distribution for the year. That's a nice benefit if you have some accounts that are performing better than others and maybe you don't want to take a distribution from that account and maybe some other accounts that aren't performing as well. Last, but certainly not least, we have to talk about taxes. When you take the required minimum distribution, you are going to owe taxes. If you're in the 22% tax bracket, and your required minimum distribution is $40,650.41, you get to pay $8,943.09 to the IRS. To make matters worse, let's go back to our chart. As you can see, that factor drops each year. So the older you get, your factor goes down. And that's likely to push your required minimum distribution higher and higher, causing you to owe more and more tax. And you have to take that money out whether you want to or not, otherwise face that 25% penalty. So what happens when the current tax law expires in 2025 and in 2026 you find yourself in the 25% tax bracket and instead of 22%, your tax bill just went up? What happens if you're married when you start taking your required minimum distributions, but now you're a surviving spouse subject to the single filer brackets? Your tax liability probably just increased because you can now do married filing joint. You're a single filer. And now what happens when your beneficiaries inherit the money? And now they have to have the account depleted within 10 years because you can no longer stretch out those distributions over your lifetime. It means more money to the IRS. Instead of waiting to hit required minimum distribution age, there are steps you can take right now to mitigate these issues. There are so many negative consequences that can happen when you don't manage your required minimum distributions. More taxes, potential penalties, even paying more in Medicare premiums. There's a lot of dominoes that can fall. So work with someone who is helping you prepare for that now. If you're already taking required minimum distributions, there are still important steps that you can take to mitigate your taxes. That's really it for required minimum distributions for now. We're only scraping the surface, so if you enjoyed today's video, please hit subscribe. It really helps out our channel, and we'll see you in the next one.